Everybody, welcome back to another edition of 5 Question Friday. This is where I take your questions that I didn't get to during the live show, along with some questions you've emailed me, and I do my best to answer them in 5 Question Friday. Now, you may be wondering, why are you looking at this fancy presentation that still has double click to edit here? There we go. Rather than me. Well, it's because I'm traveling. I am in the middle of the Arizona desert, recording this on my laptop. Hopefully, the sound will come out okay. But again, in exchange for having to look at my face, you get this fancy PowerPoint or keynote presentation for 5 Question Friday. So let's get right to some excellent questions. The first one, which financial apps do you recommend paying for, owning as a paid version as opposed to free? For those of us in or approaching retirement, great question. And to answer it, let's set the baseline, because there is one free app that I've talked about a lot called Empower that pretty much does everything that I think anybody would want. I mean, the three big tasks I think of when it comes to financial apps are budgeting, investment tracking, and retirement planning. Those are sort of the big three, particularly for those in or near retirement. And so Empower does all of those three things for free. And so the question then becomes, do other apps offer, features beyond what Empower offers that make it worth the money, right? That's the question. So let's start with Empower. Let me see if I can flip over. There we go. So this is a demo account of Empower. I just put in a 3-fund portfolio, but it does everything. It can do your cash flow and budgeting. Now, it doesn't show anything here because I've not linked any of my bank accounts to this demo, but I've used Empower's budgeting and cash flow tools for years. It was my main go-to. And basically what it will do is show you your spending by category. You can create categories, tags, and it'll try to guess at the categories like most budgeting apps do. And it's about as good or bad as all the others as far as I could tell. But you can change the categories as needed. It doesn't, if you're looking for a forward-looking budget, hey, let's map out our spending for the next year or the next quarter. Empower is not for you. And other apps, budgeting apps, have features like calendar-based budgeting, flagging subscription services, things that may or may not be important to you. If they are, then you'd want to look beyond Empower. We'll look at a couple in just a minute. From investment tracking, I would say this is about as good as the vast majority of people will need. You can look at your performance. You can compare it to other benchmarks. You can look at of course, your holdings. This is just, as I said, a basic 3-fund portfolio that updates your prices every day. You can look at your allocation. I really like the way they map this out. You can drill down. It's what it'll do. Let's go to small cap value. It shows you your amount percentage, but it also shows you where you're getting that exposure from, which funds. And so that can be very useful. So I think this is, for most people, probably the only investment tracking tool that you need. Again, I'll look at one other in just a second. And then there's retirement planning, and they have a retirement fee analyzer that we've looked at, but let's focus on the retirement planner. You can compare scenarios, you can add different income events, and it can cover pretty much anything. Pensions, inheritance, rental income. There's nothing super special behind any of these. If we clicked rental income, it gives you a little bit, but it just, it's basically just tracking dollars coming in, right? And you can do the same thing with spending goals. You can have one-time expenses, obviously ongoing expenses, and there's other settings. I won't go into the details, but you can get, I think, a pretty good picture of your retirement and whether you stand a good chance of having enough money in retirement. And you can compare plans, as I said. When you get into more sophisticated things like planning for IRMA, when to claim Social Security, Roth conversions, mapping out a change in location where you're going to live, and all these other things, this probably doesn't cut it. But again, for a lot of people, you may not need that. And for those that don't, all in all, I think it's a really good retirement planning tool. And so this is sort of our baseline for all three of those things: budgeting, investment tracking, retirement planning. And then, do we need features that Empower doesn't offer that we think are worth spending money for? And I do. For budgeting, my go-to app is Tiller. This connects your bank accounts and credit cards. But the thing is, it's different. It doesn't download that data into its own proprietary database. It downloads it either into a Google Sheet or a Microsoft Excel spreadsheet at your choice. And so you then have all of the data. Now, the thing it does is it also provides templates for those two programs. So you can look at the data in certain ways. So for example, it has one template that just outputs all of the transactions. But another one that will look at your monthly spending by budget category. Another one that looks at your annual spending. They have a ton of them, and the community has built templates that you can get. It's all part of your subscription. You can see it's $79 a year. I really like this app. It's sort of my main go-to app, but it's not for everyone. Some folks might not want to mess with the spreadsheet sort of aspect of it. So if you want a more traditional, budgeting app, the one I like is Rocket Money. Great iPhone app, but you can also look at it on the web or an iPad. And it pretty much does everything you could want a budgeting app to do. It's extremely easy to use. I will mention, and by the way, I'll link to all of this below the video, but another one I'll mention that I've started experimenting with is Lunch Money. I like this a lot. It doesn't really have a mobile app. So that might be, if you want a mobile app, Rocket Money is the way to go. But I do like the way this app works. Very easy to enter data, very easy to evaluate it. There's a calendar view. It'll show you your reoccurring expenses. So I like this a lot. Both Rocket Money and Lunch Money, I think you can get them for about $50 a year or higher. Both of them let you set the price to some extent. So on the low end, I think it comes to around 50. If you like it a lot, maybe you want to show them that you appreciate what they're doing, you can pay them a little bit more. But all very reasonable. So that's on the budgeting side. On the retirement planning side, my go-to budget or retirement planning app is Boldin. As you know, I've looked at a lot of them. I think Projection Lab is great. Prelana, I think, is good, but you really, really got to love digging into details and spreadsheets to use Prelana. For me, right now, Boldin is the best option. And again, unlike Empower, it can do a lot of things that may or may not be important to you, like Roth conversion, Social Security analysis, IRMA analysis, relocating. You're going to move to a different state. You can put that into your plan. It has a lot more detail. For example, if we go to, just as an example, income, if you want to add a pension, you're going to end up getting a lot more detail in terms of options than you will with Empower and adding a pension. Now, you may say, well, and they do have options. And so it's not that this is lightweight, but you're going to probably get more granularity with a program like Boldin. The thing is that may or may not be important to you. And it may be that Empower is all you need. So you just have to assess that for yourself. The third one, in terms of investment tracking, as I said, I think Empower is probably 90% of folks might be all they need. The one category of investor that might want something more is someone that wants to bake in research and stock screening and all of that into their tool, because they invest in individual stocks, actively managed ETFs and funds and that sort of thing. The one I like, I've not talked a lot about it on the show, but is Stockrover. This is a massive program. It does all kinds of stuff. You can connect your accounts and just track the performance and all of that. But you can look at future income. This is a demo. I think this is the Merriman portfolio I put in here, but it tracks your future income. There's a rebalancing feature that you can use. And I'm just scratching the surface. I do plan some videos on this. It has a stock screener, research tools. So, but this would probably be for a minority of folks, but I think it's an excellent tool to use, and I'll leave a link below the video for this as well. All right. That was a lot for question 1, but that's my take on it. Okay, question 2. What should someone use for a money market fund in your Google Sheet portfolio tool? I paired this one with the first question because they're related. So I have my own. This is free. It's you'll find it in this article, which I'll link to below, and the link to the spreadsheet is right here. In fact, I'll click on it just to show you what happens. It says, hey, do you want to make a copy? Let's make a copy. And this is just a demo net worth. It allows you to track your investments by asset class. And I need to do an updated video on this. This is the spreadsheet that for 2025 I want to completely overhaul. We'll see how I do. But here's the person's question. When you get to holdings, the way holdings work is you put in the ticker. and it will automatically fill in the name of that investment, the current change based on today's market, the current price, if it's a fund, the expense ratio. You have to put in shares and you have to put in the category. So for example, you'll notice here's Apple. If I change this to NVIDIA, it's going to change all of this automatically. The viewer's question is, what about money market funds? So let's take a look at one. We'll use SPACs, which is a well-known fidelity market fund. So if we put in that ticker, I didn't capitalize it, but it doesn't matter. Or I'll capitalize it just to show you that it doesn't matter. It doesn't bring up anything. So I'm using Google Finance function to pull this data in, and they don't recognize money market funds. There may be some exceptions, but most of the time they don't. So what would you do here? Well, what I do for my own is I'll just grab the name of the fund, and I can just hard code this in. Rather than using this Google function up here, I'll just paste the name of the fund in. You'll give it whatever category, let's call this cash, and I'll just leave the shares alone. I'm not going to get an updated price change, but these are money market funds, right? So I might just clear this out to get rid of the error. I don't need that because money market funds trade, they're supposed to anyway, they're supposed to trade at what? $1, unless they break the buck. And so that's all I need. And so that's how I put in money market funds into my own spreadsheet. Just sort of hand coded in there. The nice thing is the price never changes. Now my shares will change, assuming I'm reinvesting interest and whatnot. So I have to update the shares, but you have to do that anyway, right? For any investment. This does not connect to your brokerage account. So yeah, there you go. That's how I deal with money market funds in the spreadsheet. And you might use that spreadsheet to track your investments, by the way, rather than some other app. All right. Again, you can tell this was the app question Friday. Do you link your accounts to the apps you use or just enter manually? So here's what I do. I'll go back to these apps. So for my budgeting app, I link accounts. So I link checking accounts and credit cards because I don't want to enter each transaction manually. That would take forever. For Boldin and other retirement planning tools, I don't link my accounts because this is not going to give me any information about my performance, change in prices from day to day, asset allocation. All this really needs is the account balances. And I can update the balances very easily. I don't have to do it often, maybe once a quarter. You could even probably do it once a year. And that's it. So you can link your accounts to Boldin and other retirement planning tools. But for me, there's just no reason to. Now, then the last one, for investment tracking, you really have to, again, you have to link them to get all of the data. Like with Empower, you'll see your dividends, it updates your performance. You can enter accounts manually here, just like with Stockrover that I showed you. I can enter a manual account. In fact, that's what this is. This is a Merriman manual account. But you're going to lose a lot of information. Now, the question, and I didn't show it in the PowerPoint, but this viewer asked is, well, is it safe? So generally, I believe that it is. Your credentials are encrypted. They go through, each of these apps use primarily either Yodlee or Plaid, I believe, are the two main ones. And I've never had an issue. The logins are encrypted. In many cases, you're actually directed to a screen from your financial institution to enter your credentials. But the other thing I do recommend, this would be whether you link accounts or not, is always set up two-factor authentication so that even if someone had your username and password, they wouldn't hopefully have access to your cell phone or your YubiKey or however you do set up two-factor authentication. I think that's really, really important. And I would say not just for financial accounts, but also for your email accounts. Really, really important. So that's my take on it. I've never had any issues. I'm not aware of issues either that have been reported, but maybe I missed it. All right, great question though. Now we're going to take a little bit of a left turn. Could you please provide your thoughts on William Bernstein's philosophy of if you've won the game, stop playing? So Bill Bernstein, I've actually been emailing Bill. He has agreed to co-host one of my live shows. So he's going to be on the show in the second half of the year. He wrote 4 Pillars of Investing, which he just updated, and he was kind enough to send me an autographed copy, which I'm reading now. So pretty excited about that. So what this question refers to is what Bill has said, and I'll show you, I'll link to 2 things. I'll link to this article from Jim Dolly at White Coat Investor about this very topic. And this was published recently or updated recently. And then Bill was on The Long View, which is a Morningstar podcast. This was 2019. Yeah, 2019. I'll link to this as well, where he talks about this. Basically, what he says is, look, once you have enough to retire, you've got the money you need, you should have, let's call it 20 to 25 years in some form of safe fixed income kind of investments. Because why take more risk with equities? And he goes back to the 2008 financial crisis, sort of explaining why. He knew a lot of people that really got hurt bad during that period, got out of stocks, got out of equities completely at the bottom, basically, and then out of fear just never got back in, and it sort of devastated their retirement. Of course, had they just stayed the course, which is what Jack Bogle was fond of saying, if you just stayed the course, they would have been fine, right? But often they don't, and psychologically, it's easy to sit here in the Arizona desert behind a laptop and say stay the course. It's another thing to live it in a market crash while you're watching your retirement savings dwindle. And so his point is you really ought to get much more conservative in retirement. My view is there are different kinds of risks. I mean, if you go too conservative, you risk running out of money. And in fact, Bill Bengen's research shows that when you dip below about 50% in equities, at least based on the historical data, your safe withdrawal rate starts to decline. Now, I think some form of a tips ladder appeals to me for some amount of our fixed expenses. But we're not there yet, so I haven't built it yet, and we'll see if I do when we get there. So on the one hand, I certainly understand Bill's perspective. Why take risk that you don't need to take? But remember, there's more than one kind of risk. There's certainly risk of stock market crashes, but there's also risk of going too conservative and not having enough in equities so that you get the growth you need to fund your retirement. I suppose if you could build something like a tips ladder, which is inflation protected, that would last you until a reasonable period, let's say until you're in your mid to late 90s, and it would cover your expenses, that's a pretty safe thing to do, but you do give up a lot of upside potential. So this will definitely be a question that I ask Bill when he's on the show, and we can all talk, kind of ask it from different angles and see what he says. I'd be curious if his views have changed since 2019, but that's what he means. Maybe I'm more equity heavy than I should be at 75-25, but every situation is different too. A big question that I think one has to ask here is what percentage of your portfolio are you spending? What percentage of your portfolio must you spend just to get by? What are your options if the stock market had a bad 2 or 3 or 4 year run? So in that sense, every situation is different. But that's my take on it. I'll leave resources for you below the video. You can check those out. And when Bill's on the show, we'll ask him, see what he thinks today. All right. Last question. What do you make of Lawrence Kotlikoff's, hope I've pronounced that right, strong criticism of Boldin software in terms of Roth conversion analysis as compared to his MaxiFi program? Does he have a point? So I've been on Larry's podcast. He reached out to me after I did a review of MaxiFi. It's a program I like, but I don't love. But many people use it, and so obviously you'll use what you find to be the best. But what is this question? What is this viewer talking about? Well, in December, he published. That's Bernstein's website. Here we go. Let me see if I can. There we go. He published this article. I'll link to it. Boldin's, which was formerly New Retirement, Roth Conversion and Retirement Advice, Not What Economics Orders. So the upshot of this is I think this and that criticism is very much misplaced. But I also think all Roth conversion tools have their limitations. So the thing is, he first starts off by talking about a Roth conversion calculator that Boldin offers. It's right here. This is just a simple calculator. You put in your age, your gross income, and then you can put in a conversion amount, and it gives you some tax data. It's very simplistic. This is not meant to be sort of full-featured Roth conversion tool. This is just for free. Anyone can use it. And that's what he spends his time, at least the first part of the paper or the article, criticizing. And I just think that's misplaced. But then he does get to the planner. And this is where I really, really disagree with him on a lot of things. And I'll show you where the problem begins. And it begins, here we go, right here. He says, I know you can't run Monte Carlo simulations without specifying precisely what risky assets the user is holding. Well, that's just, I disagree with that. I'll explain why. Then he goes on, but John, this is a hypothetical person's not holding any risky assets because he wanted to assume someone held a tips ladder. Even if he weren't, Boldin produced its answer without asking me anything whatsoever about John's current, let alone intended, future portfolio holdings. In short, I have no idea what Boldin is assuming about John's asset holdings, apart from its belief that he's invested in risky securities when he's not. So that I don't even know, I can't even understand Larry's point here, because it strikes me as a misunderstanding of how Boldin works. Monte Carlo simulations don't need to know what investments we have. They don't need to know if we've got emerging markets versus tips, right? Monte Carlo simulations use numbers. They don't use asset classes. What they need to know is an average return for that asset class or that investment account or for the overall portfolio, and standard deviation, the fluctuation, the volatility of that. And Boldin, if we go to it, let's see here. It's here. We'll cancel this. For each account, it asks for optimistic and pessimistic rate of return. You can model future changes if you want, when it's going to happen. So you could say, well, for the next 10 years, I think it's going to be really poor because stock valuations are high. And starting in year 11, it'll get better, for example. And depending on which one you select, you put in optimistic and pessimistic, and then you can run analysis using optimistic or pessimistic or an average of the two. Whatever that average return is, Boldin uses its own standard deviation, and the way that works is the higher your rate of return, the assumption is the riskier the asset. That makes sense, and therefore the higher the standard deviation. That's all Monte Carlo analysis needs. So when we go back to Larry's criticism, I don't even understand that criticism. Monte Carlo analysis that Boldin uses is perfectly fine. And I won't go into more detail because that just kind of creates the first problem with his analysis. I will say when I read this article, I read it when it first came out, I went to my Maxify account. I don't use it very often, but I put my own numbers in as opposed to a demo. And I ran the numbers for Roth conversion, and I thought the output was incredibly wrong. It wanted me to convert basically 100% of our IRAs in the next couple of years at maximum tax brackets, which I think is just crazy. Now, that's my take. I will say that no matter what tool you use, a Roth conversion tool can only get us so far. There's just too many unknowns. It's not just tax brackets or even effective tax rate when you factor in IRMA, tax on Social Security, maybe Affordable Care Act credits if you're at that age and using the marketplace. You've got to think about when, if ever, will your tax filing status change, maybe because a spouse passes away before the other. Are you going to use qualified charitable distributions? Will the tax laws change? Will the time for required minimum distributions change as it has in the past? It's currently going to end up going out to age 75 eventually. There are all of these unknowns that, by the way, the other one is how fat your traditional IRAs will grow, how big they'll be, what the balances will be when you start taking RMDs. There's only so much we can evaluate. What I would consider a good tool, I think Boldin is, Prelana is a tool that at least gives you a direction to evaluate, gives you some rough idea. But at the end of the day, we still need to, year by year, say, okay, I know what the tool tells me. Maybe use Maxify. Okay, I know what Maxify tells me, or what Boldin or Prelana tells me. Now, what am I going to do? It's 2025. How much am I going to convert? And for me, the primary consideration for us is comparing our tax rates now with an estimate of what our tax rates will be when RMDs kick in. But that's our situation. For you, it might be different. It might be when you start spending your traditional retirement funds. For us, we probably won't spend them until we're forced to take out RMDs. You may have to spend them earlier, and so you might evaluate your projected tax liabilities earlier than, say, age 70 or 73 or 75. The thing I like about Boldin is you can do that under Insights. You can look at taxes, and you can look at estimated taxes, gross taxable income by source, deductions, net taxable income by federal bracket. You can see what bracket you're going to be in all the way out. Again, these are estimates. And so I always step back and say, okay, does this make sense? Where could this go wrong? At the end of the day, for me, if I think at a similar bracket now versus when I'll start spending my traditional retirement, I think a Roth conversion makes sense, both because I'm paying the taxes on the conversion from outside the converted amount, and therefore over time I'll get a little bit of benefit from that, and also just because the reality is in a married couple, often one is going to pass away sooner than another. We're not going to know when typically, but that's probably more likely than both passing away at the same time. That doesn't mean you won't eventually get remarried and go back to a married filing jointly, but there's going to be some period of time likely where one spouse is going to be in a higher tax bracket. And so to me, that's sort of what I'm looking for. And at the end of the day, I can use these tools to get a rough idea, but I still have to do the analysis year by year on my own to just think through, does this make sense? All of that being said, I thought this was a misguided article for two reasons. I thought his analysis of Boldin was poor, but also, Larry's a smart guy. He's got a good tool. It may not be my preference, but I know a lot of people use Maxify and like it. Just tell us why your tool's great. Just tell us how your tool's helping folks. I kind of move away from the attacking the other tools. That's just my own personal preference. There you go. All right. Well, I hope this has not been too burdensome of a 5-question Friday. Hopefully the sounds come out okay. By the time we get to next week's 5-question Friday, if things go according to plan, I should be back in front of the camera. Until then, leave any questions you have below the video in the comments. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.